Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Trader brokerage account. Today on the show, we're going to use our backtester to see how IVRank, Skew, and other volatility indicators can impact your strategy's performance. Matt, do you want to share a screen and go over our current positions?
Sure. We didn't put on any positions, so we'll just jump right into it. So, let's talk about the first two, IV rank and slope percentile. So, um, we like to use these because they're relative values. Obviously a rank. In this case, um, they and I sometimes get it confused with percentage, percentile and IVRank. So you could correct me if I'm wrong by looking in our university, Tyler. But so it takes a low and a high and puts it where in between where it falls, and that percentage is the rank. And there's another one that lines up all of the 252 observations and finds that percentile. So this is what we're showing here. So there's a graph. Hopefully you can see my screen okay. I'll move it up a bit. But for IV rank, you could tell when something happens to the market, and whenever the volatility goes up quite a bit when the market goes down. So elevators take the elevator down, um, and stocks or ETFs take the escalator up. So there's an escalator and there's an elevator. And
So
so, yeah, go ahead.
I'm just looking at the other graph there, the IV 30-day graph, and that looks pretty similar to the IV percentile 1 year right below it.
Yeah,
Um,
I mean, it's measuring the same thing. So, I mean, it's measuring this divided by that range. And so
got it.
whenever that goes up, this is going to go up with it. So but it's more of a kind of a relative um, to that history rather than, because over time, you know, the, we've been averaging around 14 or 15, and there are sometimes when it averages around 20 for a while, for a year. And then that relative, so you can't really look at, we're trying to use this in backtesting. And so when you're using things in backtesting, you want more of a relative, because we're looking at our backtest from 2007. So
Right.
many years. So we're going to want a relative reading. That's the reason that you do it instead of just in implied the implied
Yeah.
volatility number itself. That's going to vary.
Well, that makes a lot of sense, and I think it really speaks to the strength of a lot of our indicators. Is like you don't just want to use absolute values like IV 30-day, right? You want to use something that's a little bit of a stronger signal that captures more of what you're really seeing in the market. So, IV percentile, IV rank, that slope percentile, those are things that are probably better in backtesting than just the raw value itself.
Absolutely, and we're going to see a few examples in a bit. I thought this was interesting, Tyler. So since that August problem that kind of took traders by surprise, it was quite a shock. Um, that the you could see the slope percentile is just kind of gone up and stayed up, whereas before it was a lot lower. One of my arguments has been, and they did a whole article in Risk Magazine on this, but as soon as the week or the dailies hit, the daily expiration zero DTEs, the slope in the market has gone down. And let's just go look at what I'm talking about. So the slope, what I'm talking about is how high the puts are relative to the calls. Okay, so so in these types of situations, it's you could tell that the lower strikes here. So these are low strikes, and these are high strikes for this is one expiration right here. And let me just see if my drawing tool's going well. So this is February 20th, 2025. So this is one expiration. These are all different expirations, but you can see how the puts are way up here and the calls are way down here. So it's getting, that's what we call slope. I know this is negative, but we call it positive because it's usually it's usually like this, where the puts are higher than the calls.
And that's because of the expectation that the market drops faster than it goes up. So that's like the normal environment, right?
Exactly. That's a normal environment for stocks and equity related things. Now the VIX is the opposite because the VIX goes up a lot faster when the market goes down, and gold and things, and Bitcoin even, when it gets more volatile when it's going up, because that's essentially when there's or the theory is that there's much more uncertainty, and that's when there's more volatility. In those other cases, you'd see the opposite, but in most equities, you're correct, Tyler. This is how you usually would see it.
Mm-hmm.
And just to go over that concept a little bit, because I think it's an important concept that to understand the whole market maker position situation. So mostly market makers, pre zero DTEs, most banks and large hedge funds and institutions are buying puts way out of the money, and then most people are basically doing covered call writing, meaning they own the underlying and then they'll sell a call to the market makers. And so what would happen is the market makers were buying more calls. So they're buying that right around here, and so they end up lowering the calls, but the market is buying this part of the skew from them. So that's what makes the skew off than that, because like the assumptions of the Nobel Prize winning Black-Scholes is that all volatilities are constant, but in reality, it's clearly not. The puts, there's a lot more buyers of lower puts, and there are a lot more sellers of upper strike calls.
Right.
So that's typical. But what happened since the zero DTEs? The zero DTEs led, and there's so much volume now, 30%, 40%, something like that, in the zero DTEs, and it's more two-sided, meaning they're not just buying puts and selling calls. They're mostly two-sided trades. Mostly they're trading spreads. But my point has been since the beginning, and I was kind of alone in saying that this is going to be good for the market. And the reason it's good for the market is, as a past market maker, which I was, we would love this because there's a lot of two-way paper. Like, we hated it when we could only have to sell puts and only have to buy calls, because then you have a lot of risk to the downside, in addition to having a inventory that's way off. So with zero DTEs, and it leads to 1, 2, 3 DTE a lot more trading as well. They could hedge their book a little bit by buying puts and selling calls against their position that's generally short puts and long calls. Does that make sense so far, Tyler?
Yeah, and so do you think it also is compounded by, the rise of the retail trader and more options contracts being traded by people on, retail trading platforms, and there's a lot more spread trading happening on those platforms as well. You think that sort of compounds the effect that you're seeing?
I think, like I said earlier, mostly the zero DTE doesn't really compound it. It actually alleviates the problem. But I don't think retail is that big in these puts in comparison to what we're seeing from institutional clients that are having to protect certain positions that they have. So basically what I'm saying is that the zero DTE has effectively flattened out the skew. So now that we've seen that, we could go back to um, that trade builder and then think about what's happened lately since that August surprise. Slope has really gone up and stayed up. I think that must have hurt a lot of zero DTE traders, because what I'm seeing is just in this, what I drew before is that the slope is stayed up on a higher highs, whereas before it was a fair amount lower. So I think this really hurts some people here, and they're still not trading as much or something, or there are more people hedging since then. So anyway, that's kind of beside the point. So what I'd like to do now is I'd like to say, okay, well, how could we benefit from these? How could we benefit from IVRank? How could we benefit from slope percentile? So let's start with IVRank. So IVRank, again, as you pointed out, Tyler, it's basically the same as IV, but it normalizes it over time. So that's why we use it in our backtesting. So what we're going to want to do is see, like, we'll just do like an iron condor, and we will see the difference when we get in at certain times. Like if we get in when the volatility is high versus if we get in when the volatility is low, what iron condors tend to do the best in back testing, because the theory is that if you watch these figures, it's going to be important to your performance, and you don't, like, a lot of people that I see backtesting, and Tyler, you and I have talked about this, is that they'll just say, well, we're just going to put things on in zero DTE at 10 a.m. and maybe if the VIX is high, we won't trade, but mostly they're not really doing a lot of using indicators in their trading, which I'm going to show might cost people money. Okay, so far, Tyler?
Yeah, let's do it. Let's
All
see.
right.
And well, I'll let you show the signals, but I have some stuff to say afterwards.
Okay, cool. So I've run some iron condors, and what I wanted to do is I wanted to run just a typical iron condor, and then so that over time returns. Now it looks low because it's divided by the stock price instead of margin. And we could look at margins later, but I like to backtest and make it look low, and then so it's more comparable to me, these returns. But you could look at margin later, because I think it throws it off a little bit if you're using margin on some trades versus other trades. It's kind of I think makes it not as comparable and not as important. So anyway, I like to look at this versus the stock price. Now, clearly, when you put in an iron condor, your risk is only the distance of the strike, so it's going to be like magnitudes less. But let's just keep it here for a while, because we're going to be looking at different types of things to measure against it. So anyway, so just this is a pure iron condor. The DT is 30. The delta is 1, and 10, or what is it? 10 delta, buying and selling a 20 delta, I believe. Actually, let's check it out. This is our default, so I think it's maybe a little bit different.
I like how you already have these ran. We got a comment the other week that nobody liked waiting around for the backtest to finish when we were on the show.
Well, so yeah, 30 delta, 10 delta. So buying 30, selling 20. So this is just a standard backtest that we have. And then you could see, like, way back in 2007, when the SPY was 141, it was $3 wide, $3 wide there. So that's only $300 minus what you get in premium is the margin there. So what I like to look at is our P&L percentage per day, because we're going to be comparing, this is in the market 99% of the time. And since it makes money generally, something that's not in the market as much is not going to look as good. But you want to look at, when your capital is at work, how much it's making. So let's just remember this. This is our baseline iron condor. No, it's just in the market all the time. And then now what we're going to do is we're going to trade the iron condor when the implied volatility rank is both less than 33. Now the rank goes between 0 and 100, and when it's greater than 66. When do you think it's going to be better, Tyler? You could cheat and look, but
yeah, probably when it's greater. I want to answer a question we just got from our viewer.
okay.
So they asked if IVRank shows if the current IV is high or low for the given underlying. For example, an IV of 30 might be high for a blue chip stock, but low for a meme stock. And so, yes, that's correct. So the IVRank compares it to the underlying itself. So it's a great way to normalize and standardize the backtest for different types of stocks. So you could run the same backtest with the IVRank of 66 for a meme stock, right? And it would have that same effect where you're not comparing the absolute value, but you're comparing this IVRank indicator. And that's one of the strengths of ORATS indicators, is that we have the ability to go beyond just the absolute value.
Right. So, like that meme stock would have, so it looks at the rank, looks at the highest and the lowest, and it puts it where it ranks compared to those. And a meme stock, everything would be higher or lower. So you're right. So it wants to be relative to itself. So this is why this is a good indicator to use for backtesting.
It's also a great indicator to use for stock scanning too, because you're comparing relative against other stocks, and it's a great way to find them.
Exactly. And so now, I ran it with IVR, and we only got 0.43, whereas we got 0.93 here before, Tyler. Now,
yeah, but there's a difference there, right? It's in the market less often, I'm assuming, right?
Yeah.
So you kind of have to take that into account. And there's some other metrics to look at, right? Like if it's in the market 1/5 of the time, then obviously it's going to have a less return, a lower return. So what are some other metrics we can look at to see if this is truly like a better strategy?
Yeah. So we have profit and loss percentage per day. So this is, 0.005, again, very small, but as a matter of fact, maybe what I'll do is while we're waiting, we could run this return type of margins for those people that are going to want to know that.
Yeah.
Yes. So that daily return. So, and I actually just put it in the notes here. So that's short put spread. The daily returns for just the standard implied iron condor is 0.003. So it's almost double, 0.005. So we would conclude that selling it with a high IVR, and you could always use more. I just use like 1/3, 1/3, 1/3. Means that it's doing better in this case. Make sense?
Yeah. No, and it's a really important factor, because like that's a really key thing to remember. We get a lot of questions about, oh, I have this, great backtest, but it's the annual return is less, right? And you just got to realize that, yeah, if it's trading 20% of the time, it is going to be a less annual return. But you can look at metrics like the P&L percent per day, to really see that if it's a better strategy or not, as well as things like Sharpe ratio and stuff too. They factor that into account.
And what hopefully it will teach you to do, because you do want to be in the market as much as you possibly can, meaning you want to be deploying capital. And if in this iron condor, you're only in the market 23% of the time, so you're only using capital 23% of the time. You have another 77% of the time that you have to utilize your capital using other strategies. And hopefully what you'll do is have strategies that do well when the IVR is different. Like, so when your IVR is high, for example, you want to do this iron condor. When it's low, you might want to do, you might want to find different strategies. We're just pointing this out.
Not so sure do you have a entry? That's just the entry trigger. There's no exit triggers on there?
Yeah, I just did the entry trigger.
Okay, yeah. I'm curious if it would be better on an exit or not.
Yeah, I mean, again, you could optimize it many different ways. That's what for this is pretty obvious show.
Yeah.
So now let's talk about slope. Okay, so this is a slope percentile. We know it's high. We looked at the option chain. We know it's steep. So the question becomes, what should we do? If this were to flatten out a little bit, meaning, if this were to come down and this side were to go up, what is a strategy that you could look at? Now, the biggest strategy would be like, buying this and selling this side, so then when you sell it and it goes down, that's good. But this is a pretty risky strategy because you would have, like, the strategy would be, selling a put and buying a call. Well, that just gets you long. And then what are you going to do against that? You're completely long deltas. So what you're going to have to do is slide this one probably out of the money a little bit more. You could do things like 1x2s, but the way I tested it is, what most people are doing is just doing put spreads, right? So people love to do put spreads, meaning selling this put and buying a farther output. Okay, so in that case, you are technically buying the skew, right? So if the skew steepens, you bought this one near the, if it goes up, then you win. But if it goes down, then you lose. So the way that we measure skew, of course, is that, like, you're buying skew if you buy if you buy the puts. It's basically a put skew that we're measuring. So what I did is I said, well, let's run a put spread and let's look at it in terms of the slope percentile and see if that could or does affect the returns. Does that make sense so far, Tyler?
Yeah.
All right. So I just did our standard put spread. And if you go to the legacy and you go do it, it's just the 30 delta, the 15 delta. So we're buying that kind of farther out one, right? We're buying that long put, and we're selling the put around 30 delta, 30 days out. And this is just the standard, no exits, no anything here. So, and then that returns 1.18. But then again, it's in the market all the time, basically. And what we see is a P&L per day of 0.003. That's pretty standard. So now let's see, that's the one we're looking at, right? So if we're going to then look at, so then I ran this with, I said none, but I ran this with a slope percentile. Now this is a maximum this time. So the other time we wanted to do it above 66 for the implied volatility rank, right? Because we wanted you to do the iron condor when the IVR was high. Now we want to, since we're buying slope, we want to, by doing a short put spread, we want to buy when it's low, right? So we want to buy when the slope percentile is low. So that's why the maximum that we'll buy is 33, but we want to buy below that. So does that make sense so far?
Definitely, yeah.
Okay. So so now that's in the market, a fair amount of the time. And you wonder why, well, if you're only doing a third of the time, why is it so much? Because it waits, and then puts on it. We're not exiting. That's why it's more than a third of the time. Hopefully that makes sense. But look at this, Tyler. This is double.
Wow. Yeah,
So
that's a big difference. Yeah.
if people could double their returns by just looking at the slope percentile on short put spreads, I mean, I think that's a very important indicator to be watching. And of course, there are other indicators we could be looking at too. This is just a general test that I put on,
Yeah.
and then so I think this is quite an important. Again, it's just one test. You have to test a lot, but I've done this before. I like to look at the slope percentile when I'm looking at these types of trades. So that's what I like to do.
Yeah, that's a great test. It really shows the power of the indicators, and it just makes a huge difference looking at that P&L percent per day versus the annual return.
Now the problem, Tyler, is we go through all this and we say buy it but when it's shallow, but it's really steep right now. So we'll
Well, it
do
just it points to, how important it is to have a diversified set of strategies to deploy at any given time. Like you don't put all your eggs in one basket with a strategy. Having different strategies working at different times is, going to be helpful.
right. So let's do this. Let's do the opposite. So if we're selling a put spread and that gets us long slope, selling a call spread. So what we'll be doing is we'll be um, buying way out here and selling closer in. So that this kind of barbell right here, we want what we'll want to see is we're hoping that this will go up relative to this, right? So if we're selling a call spread, so maybe we sell a call spread today, and then this is one of the so here's slope. And so the steepest slope, this looks like this month looks like the steepest slope here, Feb 21. So we could actually just click on this, and actually let's do it from the let's sell a call spread down here. So we'll be selling like let's sell it enough out of the money. So let's still get a buck there. Let's do $2 here. Let's get $2 chuck. You know what that reference is?
I don't.
Um, this is giving me a good story. Used to be able to buy $2 Charles Shaw wine at Trader Joe's, and everyone would call it, I'm going to get some $2 chuck. All right, so 12, we'll go 5. Let's go out. We'll go a ways here, so we'll really profit, but so we'll do this $1.70 for, and we'll give them a cent or two. I'll change my my broker to our paper trading, and we'll force it, even though it would have filled probably anyway, and confirm that. More to that story of $2 Chuck. There used to be a guy in the industry whose dad was $2 Chuck. So what you could learn here by watching the Trader Hub and ORATS is quite phenomenal.
Yeah, lots of stories.
Yeah. All right. There we are, Tyler. We got the short call spread on, and then what I'll do is just like we like to put notes, and we could restore these. So if I'm up or down 50%, say okay. We'll say paper trading, and I'll say slope trade, and then in T Hub, that's what we're on right now. So we'll save that. And I'll also mention, should we tease this?
Yeah, we've been teasing it out. I think the last show we teased it a little bit, but it's gotten better. And I mean, we're releasing it to beta testers in the next week or two, Matt.
Yeah. So the trading journal is coming out, and you could see, like, here are all my paper trades, and you could see how it's done, and you could look at it by underlying. You could look, and it shows you the trades where you've made money, expirations. Realize it's all automated. A lot of these, if you look on YouTube and you look up trading journals, they have to plug it in all manually. But this is all comes in all automatically, Tyler, and it monitors how well you're doing. You could even how am I doing by strategies? How am I doing in iron condors? So
yeah, that's really neat.
Really
So
cool.
does this work with other like not just the paper trader? Does it work with interactive brokers and
Yeah, we're releasing it first in paper trading. It's pretty complicated to get the trades out of interactive brokers, but once we get the the beta version out in paper trading and get some testers on it, get some feedback, then we're going to start looking at brokers, Tyler.
Awesome. Yeah, I'm excited. So yeah, if you guys want to access the beta version, just shoot us an email at support@orats.com, and we'll get you access, or just comment on the YouTube video as well. We always look at those.
Sounds good.
Great. Well, thanks, Matt. Nice show. I learned a lot. I think it just speaks to the value of the ORATS indicators, the IVRank, slope percentile, way better than just using the raw value. For specifically for backtesting and stock scanning as well. And then I learned in the backtester that percent per day, P&L percent per day. That's a very important metric. Versus just looking at annual return. So it's just important to know that stuff. A lot of good information here. Thanks for sharing, Matt.
And you learned 2-buck Chuck. And if anyone knows who the reference is to 2-buck Chuck, please put it in the comments, and we'll give you a very hearty thumbs up on that. That's good trading trivia.
All right, cool. Thanks, Matt. We'll be back again next week. If you guys have any questions, just reach out to support@orats.com or leave a comment in the video. Thank you.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.